Welcome back to the Deep Dive. Today we're strapping in for a really intense examination of a single pivotal 24-hour period in the digital asset markets.
Yeah, a day that really tells two completely different stories at the same time.
It really does. I mean, on one hand, it sparked this incredible institutional panic, and on the other, it's sort of validated a completely new financial era. You've shared a stack of sources with us that paint this really conflicted picture. So our mission today is pretty simple. We need to try and extract the signal from all that noise and understand if this moment was a crisis or if it was just a massive, cold-blooded rotation of capital.
I think it was a defining moment, really. One that's just characterized by extremes. On one side, like you said, you saw what looked like a complete failure of nerve, a massive retreat from the asset that's been the undisputed king.
Bitcoin.
Right, but then on the other side, kind of hidden in the fine print, you saw the birth of something entirely new and, frankly, incredibly hungry for attention. So we have these conflicting narratives, fear versus this fundamental structural change.
And for you, the listener, trying to make sense of this, understanding both sides is, well, it's absolutely essential.
It is.
And we have to start with the number that just defined the fear. $866 million.
An incredible number.
It's a staggering amount. That's how much was withdrawn from the U.S. spot, Bitcoin exchange-traded funds, on a recent Thursday. I mean, these are the very ETFs that drove the entire 2025 market boom. They're the legal, compliant reservoirs of institutional exposure.
Yeah.
And they just experienced their second worst outflow day on record. It's nearly $1 billion just vacuumed out of the system in a single day.
And you really can't overstate the magnitude of that figure, especially when you think about the context here. These ETFs, they're the on-ramps. They're the official channels for pension funds, for endowments, sovereign wealth funds.
Right, the big money.
The big money. Before 2025, a lot of them they couldn't touch Bitcoin. Now they can, and it's easy, so their continuous inflows were the engine, the real, turbocharger of this recent market cycle.
So when that turbocharger suddenly starts spitting out $866 million in cash,
it raises some really existential questions, It asks about the viability of the entire price structure. It makes you wonder what's holding everything up.
it feels like the market just seized up. But here's the profound puzzle. The real irony that makes this story so unique. This catastrophic outflow, it didn't happen because of some terrifying regulatory disaster or a sudden inflation spike or a collapse of a major bank. It happened immediately following a major stabilizing positive macro event.
Exactly. I mean, the uncertainty that had basically paralyzed the U.S. economy for over 6 weeks, that 43-day government shutdown had just ended. The crisis was over.
All right, things are supposed to get better.
The political machinery was back up and running, and we should have seen a massive wave of capital flowing back into risk assets, just propelled by pure relief.
But instead,
investors hit the sell button harder than they had in months.
and that is the core conflict we have to analyze today. Why did stability bring panic? Was this just a psychological failure, or was it, as some of our sources suggest, a structural opportunity for large funds to finally execute a delayed portfolio rebalancing?
That's the question. Was it fear accelerating even as stability returned, or was it a cold-blooded, pre-planned move that just used the end of the shutdown as its cue?
And crucially, we have to track where some of that money might have been going, because the biggest surprise was this explosion of demand happening entirely outside of Bitcoin. And it signals the potential rise of what we're calling the altcoin ETF age.
Okay, so let's really dedicate the time needed to properly unpack this $866 million event. Because it wasn't just a headline number, it was a systemic shock. We're dealing with something that represents a pretty significant percentage of the total assets under management, or AUM, for the entire group of Bitcoin ETFs.
That's a really important point for context. I mean, if a fund has, say, $10 billion in AUM and 866 million leaves in one day, that's almost 10% of the entire fund being liquidated.
It is.
That's a massive stress test. It just speaks to the speed and, frankly, the aggression of that withdrawal.
It does. And this figure, 866 million, it's historically significant. I mean, even though the life of spot Bitcoin ETFs is short, their history is already incredibly volatile. And this was the second worst outflow day ever recorded for these U.S. funds.
The second worst. What was the only day that was worse?
We've only seen one day that managed to beat it, the undisputed champion of panic, which happened on February 25th, 2025. That day saw an even more breathtaking outflow of $1.014 billion.
$1 billion. So we're talking about a level of selling pressure that rivals the most dramatic, chaotic moment in these funds' entire, albeit short, history. This wasn't just a dip. This is a stampede for the exits. And the sources also confirmed this wasn't an isolated incident, right? It was the second day in a row of net outflows.
That's right. And for professionals, that's often the moment where they shift their risk models from, temporary profit taking to loss of fundamental confidence.
2 days is a trend.
Precisely. A single day, that could be noise. But 2 consecutive massive outflow days like that, it suggests a developing trend that institutions just cannot ignore. So now, let's go back to that paradox of the macro news, because this is where the analytical depth really begins.
Okay, so the background, as we mentioned, was the end of that 43-day U.S. government shutdown.
Right.
And you have to think about the economic environment during that period. For 43 days, huge parts of the government were just frozen. Key economic data reports, they were all delayed. Regulatory certainty completely vanished. And capital market participants, they hate that kind of paralysis. They often freeze up their trading desks. They delay any significant rebalancing decisions.
Yeah, that uncertainty, it acts like this gigantic wall, and it just dampens risk appetite and investment execution. So when the good news finally broke on that Wednesday, President Donald Trump successfully signed the funding bill, guaranteeing government operation until January 30th, 2026.
A wall came down.
The wall came down. The theoretical expectation was a strong rebound. The fog of war had lifted. Risk capital should have come flooding back in.
That was the script anyway. But the actual reaction, that aggressive $866 million exit the very next day, it suggests a really crucial mechanism was at play here, and that is delayed execution.
That is the structural speculation we have to pursue. I mean, for a pension fund or these other large institutional players, portfolio rebalancing often follows these really rigid quarterly or monthly calendars. So let's imagine a scenario.
Yeah.
A large pension fund decides 3 weeks ago that they need to reduce their high-performing, high-risk Bitcoin allocation by a certain percentage, maybe to lock in gains, maybe to meet redemption requests from somewhere else in their portfolio.
But the shutdown prevented them from executing that order, either because of compliance concerns, market illiquidity, or just the sheer political risk clouding everything.
Exactly. So the moment that funding bill was signed, the green light just flashed on. It wasn't a sudden loss of confidence caused by the news. It was the sudden ability to execute a pre-existing decision to cut their exposure.
So the end of uncertainty was just the trigger.
It was just the trigger for a rapid, cold-blooded rotation out of a high-risk asset that had recently delivered massive returns. This would explain why stability led to a mass exodus. The institutional gates were finally open for them to act.
That frames the outflow not as a sign of panic, but as a sign of discipline and compliance finally being able to assert itself. But regardless of the why, the immediate market consequences, they were brutal.
They were. I mean, when your primary source of demand suddenly flips into a source of massive supply, we're talking nearly $1 billion worth, the price correction is instantaneous. The price of Bitcoin dropped to a 6-month low.
A 6-month low. In this market, that feels like a geological age. What was that specific, painful price point?
The price point that was noted was $94,614.
Ouch.
And this is the point where that underlying, almost existential concern really bubbles to the surface. Throughout 2025, the whole narrative was driven by continuous ETF demand. It was often reinforced by these really well-publicized corporate purchases, like the ones Michael Saylor's company is always announcing.
Right, the thesis was simple. ETFs provide endless liquidity and perpetual upward pressure.
And if that fire hose of ETF capital suddenly disconnects and starts, sucking water back out of the pool.
Yeah, to use that analogy from the critique.
Then the very foundation of the 2025 bull run starts to crumble.
So the fundamental question is just inescapable at that point. If this pattern of net outflows continues, even for a few weeks, what mechanism sustains the current price level?
Exactly. The market is now entirely dependent on these institutional flows, and those institutional flows are showing that they can execute massive directional selling events with stunning speed. And this is why the debate we're about to get into is so critical. We're looking at whether the old rules of engagement even still apply when you're faced with this completely new structural reality.
So this massive outflow and the sharp price drop, it immediately polarized market analysts.
Yeah.
I mean, you have the technical contingent, the people who see clear, quantifiable danger lines in the charts.
Right.
And then you have the structural contingent who argue that the entire game has changed. And that makes past history totally relevant.
Right.
So for you, the learner, Understanding both of these conflicting viewpoints is where the real insight is.
Let's start with a technical perspective, which is it's deeply rooted in on-chain data and investor behavior. This view comes from Ki-Young Ju, who is the CEO of CryptoQuant, a major crypto data analysis platform. And he provides us with a very clear, very specific red line for panic.
And his core argument is that the bull market structure is technically still intact, but it's precarious. It's hanging by a thread. And the critical number, the psychological and technical line in the sand, is $94,000. So why is $94,000 the number we should be so focused on?
It's all about investor psychology. And that psychology is enforced by what's called the realized cost basis. The $94,000 figure represents the average cost basis. So the median price paid by all the investors who purchased Bitcoin over the last 6 to 12 months.
Okay, so it's like the collective emotional breaking point for everyone who got in recently.
Exactly. We aren't talking about the early whales who bought at $10,000. We are talking about that massive block of institutional and sophisticated retail money that entered during all the ETF euphoria.
And if the price stays above 94,000, that entire group, that cohort, remains in profit. Or at the very least, they're break even. So that minimizes the incentive for them to panic sell. They can just rationalize holding through the volatility, expecting a rebound.
That is the power of realized profit. As long as they're ahead, hope prevails. They might HODL, as they say, onto their position, even during a dip, just reasoning that the long-term thesis is still sound. So this collective profit status, it acts as this powerful psychological buffer against mass capitulation. It stabilizes the market by keeping a huge amount of supply off the exchanges.
But if we breach that red line, the whole dynamic shifts completely. If the price drops below $94,000, then the technical dip triggers a psychological crash.
Exactly. Once that price threshold is broken, the entire recent cohort, the engine of the last 6 to 12 months of growth, they start seeing their capital just evaporate. And the source material notes that when investors cross that line into collective unrealized loss, fear rapidly converts into mass selling.
They rush to cut their losses before it gets worse.
They do. And this fear-driven cascade, it creates a self-reinforcing bear cycle. So that technical marker is the tripwire for the psychological stampede.
So Ju's stance is therefore cautious, it's data-driven, and it's disciplined. He's basically saying, watch the data, not the drama. And the data says, we're technically safe for now.
Yeah, his conclusion reflects that discipline. He says, quote, I personally don't think the down cycle is confirmed unless we lose that threshold. I'd rather wait than rush to conclude. And this is exactly the kind of analysis using objective on-chain metrics like realized cost basis that helps you as a learner avoid those emotional market responses. It replaces your anxiety with preparation.
All right, now let's pivot sharply to Hunter Horsley, the CEO of Bitwise. He represents a completely different school of thought. He essentially looks at Ju's technical analysis and says that map is obsolete.
Yeah, Horsley's argument is purely structural, and it's a direct challenge to anyone who's relying on historical crypto patterns. His claim is that the popular 4-year cycle theory, the idea that strong growth tied to the Bitcoin halving is always followed by an inevitable, predictable decline, is now irrelevant. The game, he says, has fundamentally changed.
And this structural change is the key insight. Why does he feel the old cycle rules are dead? What are these new structural factors?
Well, he cites 2 factors that fundamentally alter the market's elasticity and its behavior. The first and most important one is the introduction of Bitcoin ETFs. This means the market is no longer dominated by retail investors who operate on a 4-year halving-driven calendar. Instead, you've got pension funds, massive asset managers, endowments.
And these institutional players, they don't care about the halving date. They care about the financial quarter, right?
Precisely. Their decision-making process is based on fiduciary duty, on compliance, quarterly performance reviews, and annual rebalancing cycles that are dictated by traditional finance rules, not by crypto cycles. So if a pension fund sees a massive gain, their internal rules might actually require them to take profit at the quarter end just to meet their diversification mandates.
And that completely decouples their selling pressure from any underlying crypto-native cycle.
That is the structural shift. And the second factor he mentions is the new U.S. administration, which suggests that regulatory environments and political priorities are now this constant shifting variable that fundamentally alters investor risk calculations compared to previous cycles. The market isn't just technologically different anymore, it's politically and institutionally domesticated.
Which leads into this incredibly bold, counterintuitive hypothesis. He suggests that the recent price drop isn't the start of a bear market, but the end of one.
It's a profound statement. His claim is, quote, "I think there is a decent chance we've been in a bear market for the better part of 6 months and are about to come out of it." I mean, he's arguing that the prolonged period of consolidation, that grinding sideways movement where so many retail investors felt frustrated, that was the bear market, and it was quietly absorbing a lot of selling pressure.
That sounds a little bit like wishful thinking, arguing that the pain is already over.
Yeah.
I mean, what specific metrics beyond just the ETF structures support the claim that this wasn't just consolidation, but a true bear market that's already been absorbed?
And that's the critical challenge to his argument. Horsley is basing his confidence on the sheer magnitude of the capital that has been introduced, regardless of that one-day $866 million outflow. He's implying that the institutional groundwork, the plumbing, as he called it, is so robust that it has already stabilized the floor.
So the outflow, in his view, is just the final washout.
Exactly. The last bit of volatility caused by the execution of those delayed decisions before the fundamental strength reasserts itself. His conclusion is really simple. The plumbing for crypto has never been stronger.
So we have this perfect tension. The technical indicators are screaming caution at $94,000, while the structural optimists are arguing that history is useless and the foundation is fundamentally sound. For you, the listener, the key is knowing which lens you're applying at any given moment.
So while Bitcoin was absolutely dominating the headlines with its multi-million-dollar outflow crisis, the real long-term story was quietly unfolding in the regulated altcoins space. And this data suggests that the fear around Bitcoin did not translate into an overall fear of the entire digital asset class.
Right.
Instead, it seems to have triggered a rotation into other accessible, regulated growth narratives.
This is where we shift our focus from fear to just unprecedented demand. The market is not a monolith, as you said, and the star of the show that day was XRP, which validated this idea that institutional money is desperately seeking diversification beyond just Bitcoin.
The launch of the Canary Capital XRP ETF with the ticker XRPC was...
Well, simply put, it was electric. It was the first spot XRP ETF in the US. And its performance wasn't just good. It signaled that years of pent-up demand, which had been suppressed by regulatory uncertainty, were finally being unleashed. And to really understand why this launch was so shocking, we should probably quickly provide the regulatory context. XRP had been under this intense regulatory scrutiny for years in the US. What did its eventual regulatory clarity mean for investor appetite?
Well, that whole regulatory saga meant that for years, major US-based institutions, we're talking traditional banks, asset managers, even many retail brokerages, they avoided XRP like the plague. Even if they believed in the underlying technology, the legal risk was just too high.
Right.
So the subsequent court rulings, which provided significant clarity that XRP was not in all instances an unregistered security, that completely changed the compliance calculus. The massive legal uncertainty was like a dam.
And the ETF launch broke the dam.
The ETF launch was the breaking of that dam. And the data proves just how much demand was sitting behind it.
So how stunning was the XRPC launch performance relative to its competition?
XRPC's launch surpassed every single ETF launch, crypto or traditional, in all of 2025. This wasn't just a strong performance, it set a completely new benchmark for asset launches in what was a highly competitive year.
And we have the hard data here. This was confirmed by Bloomberg ETF expert Eric Balchunas. What was the exact launch day trading volume?
Balchunas confirmed the launch day trading volume for XRPC hit $58 million. And he even took to social media to emphasize the sheer volume of this, especially considering the overall market environment that day was just dominated by Bitcoin fear.
$58 million. What does that mean for the next wave of altcoin ETFs? Does this set a new baseline for what success looks like?
I think it absolutely does. I mean, the previous 2025 launch record was $57 million, set by another unspecified ETF. So XRPC beat it by $1 million, making it the definitive champion. And Balchunas noted that these top two performers were, in his words, in a different league.
Wow.
The third highest launch in 2025 was more than $20 million behind them. So this massive gap, it highlights that investors are not just passively diversifying. They are aggressively targeting specific assets that offer a compelling growth story and now have the compliant wrapper of an ETF.
This is just a powerful categorical validation of regulated altcoin demand. It suggests that institutional players are eager to move beyond the BTC and ETH duopoly.
It proves that institutional money isn't just seeking exposure to crypto as a monolith. They're seeking exposure to specific use cases and narratives that they feel offer superior growth potential, especially now that they can access them through safe channels. The fact that the $866 million outflow happened on the same day that a $58 million XRP inflow happened, that paints a picture of rotation, not wholesale market rejection.
Okay, now in the spirit of balance, we have to acknowledge that not every major altcoin escaped the market jitters that hit Bitcoin. I mean, Ethereum, the second largest asset, it definitely felt the pain. It shows that even diversified assets aren't entirely immune to a systemic shock like that.
That's right. Despite the success of the new XRP launch, Ether ETFs did suffer alongside Bitcoin. They saw a notable outflow in $259 million on that same day. And this is a really important counterbalance. When institutional investors execute a massive risk reduction maneuver, like the delayed execution we talked about in part 1, they often just cut across the board in their high-risk categories. That means Bitcoin, Ethereum, and others.
But the contrast reappears when we look at Solana. Solana ETFs, often considered a growth-oriented high-risk asset, they showed some surprising sustained resilience.
Yeah, Solana ETFs offered this beautiful counter-narrative. On that volatile Thursday, the same day as the 866 million Bitcoin exodus and the 259 million Ether exit, Solana ETFs received a distinct inflow of $1.5 million.
It's not the massive volume of the XRP launch, but the context is everything.
The context is everything. And this wasn't just a random spike either. The source material notes this $1.5 million flow marked the 13th consecutive day of inflows for Solana ETFs.
A 2-week streak of institutional accumulation, while the two largest assets are experiencing chaos. That's significant.
That accumulation streak is the quiet confirmation of a structural long-term belief. It suggests that a specific cohort of professional investors is treating Solana as a distinct, long-term, high-growth investment, and they've decoupled it from the short-term noise surrounding Bitcoin's price action. It really highlights a conviction that goes beyond immediate sentiment.
So Solana is quietly accumulating wealth, while Bitcoin is having this meltdown party.
It's the silent assassin of the crypto world right now. So when you synthesize this data, the record-smashing XRP launch, the Ether stability check, and that incredible 13-day streak for Solana, the message is pretty clear. The market is maturing by spreading out.
Absolutely. The combined data clearly shows that the cryptocurrency market is not a monolithic block that's dependent solely on Bitcoin sentiment anymore. Investor demand is actively shifting. It's searching for new growth stories, new diversification opportunities away from the now mature and, frankly, volatile Bitcoin trade.
And regulated altcoin ETFs products like XRPC and the Solana funds, they are proving to be the critical channel that's unlocking this new wave of sustained professional interest. The market is evolving into a genuinely multi-asset digital economy.
Okay, so we have navigated massive capital flows, political uncertainty, technical red lines, and structural revolutions. For you, the learner, the goal now is synthesis. How do we convert this chaotic, fascinating story into durable, actionable knowledge?
I think the first lesson is foundational. It's about the importance of intellectual discipline and recognizing that data is your best defense against panic.
When I see that $866 million number, my immediate human reaction is just panic. I mean, how do professional fund managers who have just gone through a 43-day shutdown justify hitting the panic button so quickly? But then market analysis, specifically Ki-Young Ju's technical view on that $94,000 cost basis, provides a technical shield against that pure emotional reaction.
And the application here is self-control through preparation. You have to use data points like that $94,000 cost basis as a precise psychological marker. This figure tells you where the market's collective pain threshold lies. And it allows you to prepare for scenarios where panic selling might amplify, rather than just being swept away by the panic itself. You're using the market's own mechanics to set your expectations.
Right. If the price is $94,613 as it was, you know you are $600 away from potentially triggering a massive wave of fear. That knowledge allows for preparation, for contingency planning, and for disciplined waiting, rather than just emotionally reacting.
Knowing where the tripwire is allows you to stand back from it. Preparation replaces reaction. And this knowledge is essential because volatility is not going away. Understanding the underlying fear mechanisms is how you mitigate your exposure to them.
The second major lesson is driven home by the incredible success of XRP, and that's sustained accumulation in Solana. This data proves, I think, unequivocally, that the institutional gaze is no longer fixated solely on Bitcoin.
The application for you as a learner is a direct and forceful call for diversification. If you only looked at the $866 million BTC outflow, you would have concluded the entire sector was melting down. But if you looked at the $58 million XRPC launch, you'd see record institutional hunger.
You just can't put all your strategic eggs in one basket and assume that Bitcoin's trajectory dictates the entire digital asset economy anymore, especially now that regulated ETFs allow these institutions to cherry-pick the assets they want.
Exactly. Opportunities are now actively sprouting in corners of the market that were previously inaccessible or just too risky because of those regulatory clouds. And this means your research has to extend beyond just the top 2 assets if you want to capture the next wave of institutional interest. The old rule was, as Bitcoin goes, so goes the market.
And the new rule is?
The new rule is, as regulated access expands, so does diversification.
Hunter Horsley's point, that the 4-year cycles are dead, is perhaps the most vital structural insight we've discussed today. If you are relying on historical charts, you're basically using an obsolete map for a new territory that's being built by institutional compliance departments.
And this is a call for continuous knowledge updating. The introduction of these institutional players, pension funds, traditional hedge funds, it means volatility is now driven by things like quarterly performance reviews and portfolio risk modeling, not just the halving event.
The old market was governed by code. The new market is governed by compliance.
And compliance moves a lot slower, but its impact is massive and directional, as we saw with that $866 million likely delayed rotation. The application here is just brutal honesty. Relying solely on historical cycles or the old rules will probably lead to incorrect assumptions and strategic errors. You have to integrate traditional finance, mechanics compliance, the quarterly calendar, fiduciary duty into your crypto analysis moving forward. Hashtag 4.4, final self-reflection questions.
Ultimately, these events demand some strategic self-reflection. We've synthesized the data, but you, the learner, need to internalize it through some critical questioning.
Right. First, you have to solidify your strategy. Ask yourself, what is my personal strategy? Am I operating based on a long-term belief in the underlying technology, or am I just engaging in short-term trading? That $866 million shock should affect a short-term trader far more than a long-term believer.
Second, analyze your exposure. Ask, am I too concentrated in a single asset? The XRP and Solana data is a powerful warning against single asset concentration, and it proves that success stories are now branching out.
And finally, the measure of true discipline. Am I letting emotion override logic during this market volatility? Identifying the $94,000 mark and understanding the structural arguments helps you recognize when raw fear is taking over and when data should truly be guiding your hand. This is the difference between surviving volatility and profiting from it.
And answering those questions honestly is far more valuable than trying to guess the exact price of Bitcoin next week. Hashtag outro track.
So to recap this deep dive, we dissected the dramatic, nearly billion-dollar Bitcoin outflows, an $866 million shock that pushed the price down to $94,614. We navigated the conflicting expert views, Drew's technical $94,000 red line versus Horsley's structural argument that the old cycles are dead and the foundation is fundamentally sound.
And most importantly, we uncovered that hidden truth. The massive record-setting demand for altcoin ETFs, which was evidenced by the explosive $58 million launch of XRPC and the persistent structural 13-day inflow streak for Solana. It's a story of rotation, of diversification, and a structural change, not just market rejection.
Which brings us to our final provocative thought for you to carry forward. The central conflict that's going to define the next phase of the crypto market is not Bitcoin versus traditional finance. I mean, that battle is functionally over, thanks to the ETFs.
Right.
Instead, the real conflict, and where the most dramatic growth may occur, is Bitcoin versus the rising regulated demand for its structurally unique altcoin competitors.
And the question you really must mull over is this. Is this episode of Massive Outflow proof that single asset dominance is finally fading? Are we witnessing the inevitable transition to a genuinely decentralized, multi-asset digital economy where assets like XRP, Solana, and others compete for institutional capital on regulated terms, forcing Bitcoin to simply become one large, stable asset within a much broader universe?
The data strongly suggests that diversification is becoming the new institutional norm. Thank you for joining us on this deep dive into market structure and psychological tipping points. We encourage you to reflect on these insights.
And we'll be here next time, ready to dissect the next layer of complexity in the markets you need to understand. Until then, stay informed.